Hey, what's up, my friend? So, in this video, I want to share with you 7 of my best trading tips, right, that will improve your trading results. So, keep watching. Okay, so the first Forex trading tip that I have for you is number 1. Enter your trades near market structure. So, let me share with you how not to do it, right? So, firstly, right, often traders will look at a chart, right? So, let's say, for example, the red one here is your stop loss, the green one is your entry point, and the blue one is your so-called take profit level. So traders, they would see this chart and they say, oh man, the price is coming down lower and lower. Let me hop on board before I miss the move. So they go long at the green area, right? Have their stop loss at the red level, which is a distance away from the highs, and then they target at the nearest swing low, right? That is a very common thing that traders would do. But when you look at it from a risk to reward perspective, right, you can see that you're in fact risking this much, you're risking this much to make this much, right? I would say risking a dollar to make like 40 cents, right? So really, right, if you want to improve your risk to reward, right, you want to trade near market structure, which is this example that I want to share with you. This one over here, it's much better because if you look at it now, right, your stop loss level is at the same level. Your take profit level is at the same level over here as well. The only difference, right, is now you're entering at a much favorable trade location. You're entering at market structure. In this case, near resistance, right? You won't necessarily go short, right? Because you might want to wait for a reversal candlestick pattern like a shooting star, a bearish engulfing pattern before you go short. So perhaps the price may come up higher and then get smacked down lower and close lower. So from here, you can see that, from a risk to reward standpoint, let's say, it closes lower, you enter somewhere here, your stop loss is still at this level, all right? Let me just remove some lines, right? Let's say what happens now is that, you're not going to use a sell limit order. You let the price go up and then come down and close lower somewhere here. So your entry now will be somewhere here and your stop loss is now here. Now, this is your risk. And your reward is now from your entry point to your target profit. So now you can see that you're risking $1 to maybe make $1.50 or even $2. Right? Your risk to reward has been improved just because you are trading near market structure. So that is what I mean by number 1, right? You want to trade near market structure to improve your risk to reward on your trade. Right? So that's the first tip I have for you. The second tip is this, right? Is that you want to trade breakouts with build up. So what is build up, right? Let me explain. For those of you who have been following me for a while now, you're already a pro at this. So a build-up simply means, right, a tight consolidation where the range of the candles gets smaller and smaller. So you can see that over here, this blue box, this is what we call a build-up over here. This over here is a sign of strength because if you think about this, right, price at resistance, it usually would have selling pressure, right? Traders looking to short resistance. Like for example, in the previous example, right, I said that, traders might want to consider shorting at resistance near market structure. Now, what happens is if after 10 candles, 15, 20 candles, the price is still hovering at resistance, what does it tell you? Well, it tells you that the selling pressure, it's unable to push price lower. That's because there are traders are willing to buy at these higher prices. That is why the price can't go down. Right? So this is a sign of strength because the price is still hovering at resistance, right? Buyers are willing to buy at these higher prices, willing to buy in front of resistance because they have the expectation that the price will break out. Right, so this is a sign of strength. Whenever you see the price forming a build-up, okay, a build-up over here just prior to the breakout, this is a sign of strength that the market is likely to break out higher. Another variation of this, right, is what we call higher lows into resistance. This is a sign of strength as well. Notice you see higher lows, higher lows, higher lows, higher lows into resistance. The concept is somewhat similar to the build-up, but this time around, it's telling you that buyers are willing to buy at these higher prices. That is why you see higher lows into resistance, right? So this is also another sign of strength, right? And this is the third tip for you. The fourth tip that I want to share with you is what I call the first pullback. So often, right, the price, it can break out. And if it breaks out, right, you might have missed the move, right, if you didn't catch the breakout. But don't worry, because more often than not, right, the price will give you a chance to re-enter to catch the trend. So in this case, you can use the first pullback technique that I'm about to share with you. So you can see that over here, the price, it did break out. Okay, so those of you who missed the move, don't worry because over here, the market offered you, right, an opportunity to get long, right, by forming somewhat of a bull flag pattern. So what you can do is to trade the first pullback. If the price does break above this swing high, you can look to get long, right, and possibly have your stop loss, just a distance away from this low, maybe somewhere over here, right, a buffer away from this swing low. So this is what I mean by the first pullback. So don't worry, if you miss the breakout trades, right, there's always opportunity. I mean, there's a good chance that you can get opportunity to hop on board and catch the trend. Right, so that's the fourth tip for you, the first pullback. The fifth thing that I want to share with you is to set your stop loss, right, away from market structure. Because often what traders do is that, let's say the market is in a range, okay? They go long, right? Price hits up higher, they go long over here. Where do they put their stop loss? They put their stop loss just below this level of support. And what happens? Well, the market could just as well, come down lower, trigger your stop loss, and then continue higher. So this is why, right, you don't want to put your stop loss just below support or just above resistance. It's like asking the market to, come eat my stop loss, right? Take my money, it's free, just stuff it down your throat. You don't want that. So what you want to do is to set your stop loss, right, a distance away from market structure. So how do you do that? Very simple. You can see over here, right, this example, the market here is somewhat in a range, right? Traders, you can see that, it is at an area of support, right? Price tested once, twice, thrice, right? Then at, 4 times. Okay? So you can see that, this candle over here, this low has pretty much taken out this lows over here, this lows over here, this lows, and this lows over here. So this one candle has pretty much wiped up all the stop loss, right? The cluster of stop loss below this area. So this is why I say, you want to set your stop loss, right, a distance away from market structure. And how do you do this? It's very simple. Firstly, you can use just your eyeball, just eyeball the chart and see, okay, let me just give it some distance from, from here to here. I'll set my stop loss somewhere here, right? That's what you can do. Alternatively, you can use an indicator like the average true range, right? What it does is that it measures the volatility of the market. Pull out this indicator, it will give you a value, call it X, right? So what you take is the value of X, right? You calculate what is this low, right? And then minus it by X. So if the value, let's say, is the market price level at support is $100, and let's say X is $10, right? You put your support at $90. Pretty simple, right? So that is how you actually protect yourself, right, from getting stop hunted. Right? So this is the fifth tip that I want to share with you. Set your stops away from market structure. The sixth tip that I want to share with you is entry technique, right, to profit from traders who long breakout and then they got trapped. Here's how it works. So this is what I call the false break setup. So you can see that over here, area of resistance, market broke out of resistance on this candle. You can imagine, right, that actually at one point in time, this candle was looking bullish. Something like this. Okay? Sorry, let me just redraw this. Looking bullish, something like this. The market has not closed yet. And then halfway, right, throughout the day, right, the sellers took control, pushed price lower, and finally, right, it closed like this. It closed like this. So this is why you got this candle over here, this candle over here is pretty much this candle over here. So at one point in time, it was actually looking very bullish, right? Buyers are in control, traders pile on the breakout, let's go long, right? It's going to the moon, and then suddenly it reversed and closed lower over here. So you can see that the psychology of the markets now, what's happened is that breakout traders who are long are now trapped, right? Because they buy the breakout and the market does a 180-degree reversal. They are now trapped. And if you think about this, right, where did the breakout traders put their stop loss? Chances are they put their stop loss maybe below this low, here, or even here for those of them who are really, really conservative. So what you can expect is that if the market, right, the price were to continue lower, it's going to hit this stop orders, this sell stop orders, which is the stop loss orders of the breakout traders, and it would induce further selling pressure. So this is why you can expect the market to continue lower. It's not guaranteed, right? But there's a good chance that it will continue lower after this false break price pattern. So you can use this false break, right, as an entry trigger to, get on board trends, time your pullbacks and stuff like that. It's a very useful entry technique to use. And that is the psychology behind the false break setup. And the last tip that I want to share with you is this, right? Use limit order for a better risk to reward on your trades. So let me share with you an example. So you can see over here, all right, this is the chart of Euro Yen 4-hour time frame. How do I know that? Because it's over here. Okay, so this is a very typical setup that traders would trade. Price is at a area of support, right? You come into the area of support, right? Notice that it tested once, twice. You can pretty much mark up your support level. It's going to be quite obvious. And then this bullish reversal candle is so bullish, right? It suddenly just did a massive reversal and closed near this highs over here. So now if you follow the techniques I just shared with you, you don't want to set your stop loss just below the level of support, right? you want to set it some buffer away. So let's say you put it somewhere here. Now, if this is going to be your stop loss, let's call it SL, and this is going to be your entry, you can see that your risk, your potential risk on this trade is very large. Okay, you can see that this is the distance of your stop loss. Very, very large, right? And if you don't want to trade it, and I can understand it, because if you have a larger stop loss, you have to reduce your position size to still have a proper risk management, right? You might not want to take the trade because the stop loss is very large. So what you can do is to use a limit order to have a tighter stop loss, and in turn, right, you can increase your position size on this trade. So an example is, let me just change this color. Let's say you decide to use a limit order, and you put it, say, a limit order somewhere here, like a Fibonacci level, like maybe you just take from this swing low to swing high, and you identify the 50% level mark. That is where you will enter the trade. Your new entry is now over here, right? Let's say this is just one of the technique that you use. Now, what you'll notice is that your stop loss, right, the distance of it has been reduced. Right now, this is the distance of your stop loss. All right, and from a risk to reward standpoint, you have improved on it, right? So instead of buying near the highs, what you can do is use a limit order, get a better price level, thereby improving your risk to reward on the trade. Now, the downside to this approach, right, is that sometimes the market may not come to the level that you're looking at, right? Especially if you set it at a very low level, there's a low probability of it actually coming to that level, and you may not get filled, and you might miss the move. So this is kind of like a balance between where you think the market could possibly go to, right, and then having a better risk to reward on the trade, right, and pretty much trying to get an overall better return on it, right? So if you ask me, right, where do you usually set a limit order? A rough guideline is this, right? Is you want to put it near the market structure, where the previous market structure is. So in this case, right, you can see that over here, this was the previous market structure, this area of support. There's a good chance the market could retest it. You could set it at this level, right? So this, to be honest, right, is obviously cherry pick, right? So sometimes what you will see is that the this level of support may not be so low. It may be somewhere over here. Let's say somewhere over here. Okay, so I would pretty much put a buy limit order at this support level. Okay, let's imagine that this black line has moved up higher to somewhere this level, right? I would put a buy limit order at this support level, or just before it, right? And see if I can get filled and get a better price point compared to buying near the highs. All right, so this is another tip, right, to use limit order to improve your risk to reward on your trades. Okay, so just a quick recap, right? Number one, you want to enter your trades near market structure because overall you get a better risk to reward, right? Number one is because stop loss is tighter, and when you have a tighter stop loss, you can increase your position size and still risk the same 1% of your capital, right? Compared to having a wider stop loss, right? You have to decrease your position size to risk that same 1% of your capital. Number two, you want to trade breakouts with build up. Number three, higher lows into resistance is a sign of strength. Number four, the first pullback, right? It offers you a chance to catch the trend. So often, if the market does break out, right, sometimes it may not retest back previous resistance turn support. For example, what you will look for is a trend continuation trade, like maybe a bullish flag pattern, right, to trade the breakout of the highs to get on board and catch the trend. That's the first pullback. Number five, you want to set your stop loss, right, away from market structure, because as I've shared earlier, if you set your stop loss just below the low, it's going to get triggered very easily. So give it some buffer. You can set it 1 ATR below the lows, right, for your stop loss. The false break technique is a chance for you to actually profit from breakout traders, right? So if the price breaks above, like say, resistance, and it reverses and close lower, you know that traders who long the breakouts are now trapped, and you can actually take advantage of it by going short, by going against their trade direction, right? And lastly, right, you can use limit orders to improve your risk to reward on your trade. Okay, so with that said, if you have enjoyed, right, this video and you want to learn more, I would suggest you go down to my website over here, tradingwithrayner.com, right? Over here, I share pretty much trading strategies and techniques, right, to help you profit in the financial markets, right? And scroll down a little, I recommend downloading these two trading guides. One is called the Ultimate Trend Following Guide, right, where I'll share with you how you can actually ride massive trends in the financial markets. And the other one is more of a price action trading, how to better time your entries and your exits. Okay, so go to my website, download these two books, right? Click this blue button and I'll send it to your email address for free. Right, and that's it, right? If you've enjoyed this video, right, leave a thumbs up button. Yeah, right? Subscribe to my channel, and if you have any questions for me, let me know below and I'll do my best to help. With that said, I'll talk to you soon.